All right. Hello, everybody. Thank you so much for joining us for our next affiliate club interview. I am Suzanne with Welcoming Wow. I am your vacation rental business coach, and I am here with both Tiffany and Seth. If you could tell us a little bit about who you are and what you do, that would be great.
Sure. So I'm Tiffany. Nice to meet you all. We own 10 STRs. Well, we own a couple that are interchangeable, some midterm, some long-term, but we have about 10 investment properties. And we are very, very knowledgeable in that field. But also we own a mortgage company that we have a little specialty in STRs, and I'll let Seth introduce himself.
Yeah, I'm Seth. I'm the broker, Full Circle Home Loans. Been in mortgage since 2003. And really got into short-term rental, like a little more of the financing side and personal investing in 2017. So about 5 years, just been, learning more programs, better programs for various clients and first-time investors to experienced investors. And so it's become fun. I usually work with first-time buyers or short-term rental investors. It's like kind of opposites,
Yeah.
Would be two different segments. Yeah.
Yeah.
So tell us specifically then, looking at the STRs or the short-term rental market and how you would normally help them, since that's a lot of what you do. How do you specifically help them?
Here you go.
You're never shy. You can do this.
So STR investing is definitely different than when you're evaluating a house for a primary, different criteria. So specifically, aside from obviously qualifying them for the loan and telling them this is what you qualify for, things like that, I would say that we help them a little more than the typical loan office, because we can actually kind of set them up for future investments. Sometimes loan officers will do things that do not make sense, and it makes it so they're kind of blocking their buyer from buying for another year or two because they don't understand STRs and the way the income comes in. They calculate things out like a normal investment purchase, which is different, where you would have a signed lease. So I feel like are a little better at, because we own so many and have, we've sold so many STRs, flipped STRs. So we know how to set the client up in the future to get financing more than once, versus like just doing a 10% second home, loan. And then after that, they're like, well, I'm stuck now because I don't qualify for anything. We can tell them exactly how to qualify for more in the future. If you have anything to add to that.
Yeah, I mean, what we do is, regarding the vacation rental purchases, is it always starts with like, what is the price point and down payment and affordability that they're targeting? Are they looking to use it primarily as a vacation home, or is it a rental property? Is it both? And because it determines which loan program to do. And there's that, we need to balance the affordability and qualifying with the right loan program. And to Tiffany's point, most of our clients don't just buy one home. It's because normally it's fun, they like it, they're doing well.
Even when they start out with one and say it's the only one, it never sticks at one.
Yeah. So, and that's awesome. I think real estate's changed our lives, and I'd love to see every American buy a home and multiple homes and have that dream and landlord, asset building. And so we try to examine that. And sometimes it's just one a year client buys, which is great. But we just need to analyze like where they want to go to. It's like not just fill out our application and get started. It's like a conversation of goals.
Wonderful. That's fantastic. I remember when I was in banking, that was usually one of my first questions when people came to me for a loan request. It's like, well, first of all, what are your goals?
Yeah.
Because it is one of the most important questions, because it's like, let's stop for a minute and think about that. So really thank you for bringing that up. Yeah.
Yeah. Otherwise, they just kind of like focus on just the one house and they don't think about long-term. And that's so important.
Right. And you guys probably have strategies of uncovering a little bit more with your clients that you deal with to see if are you really going to just do one, or maybe let's talk about possible future, scaling that a little bit. Okay. Absolutely. So what would be some different options as far as a loan that somebody could get to purchase a short-term rental?
Yeah, so a common one is a 10% down second home. That's a vacation home loan. And as much as it's a common loan, it's a good loan. And it's a good starting point with any client. If they can qualify for that, it's a very much go-to loan for our clients. And if they can put more money down, I would recommend it if they have it, because the terms get a lot better based on what's changed over the last 6 months. However, if people want to scale, or if they're kind of a little bit nervous about having, they want to have extra reserves, they need to have money for furniture to get the home ready. There's a lot of factors, and the 10% down is a very good option. The next option after that, that's really common.
Just to back up on that,
Sure.
two things on the second home loan that people always tell us, because there's big discrepancies, is whether or not they can rent out a second home. And most of our reps are saying the same thing, which is that as long as it's not professionally managed, and as long as the owner uses it a reasonable amount of time throughout the year, it is still considered a second home. So you can rent it out, but you have to self-manage. Now, some banks have overlays on that. So every bank is different. We are brokers, so we can broker it to a bank that is okay with that and has those rules, versus one that might have you sign something saying this will not be a rental in any capacity. So that's very, very important. So second home loan, you do have to use it a reasonable amount of time throughout the year, and it's not supposed to be professionally managed.
Okay, good point.
Yeah, and I'll kind of jump in a little bit more on that. Like the second home, people do it because it's a less money down loan. That's like, so if someone's going to try to take advantage of that, it needs to be, the intent needs to be there. And the first 12 months of once you close on your loan, your intent is to do what? If it's long-term, to become a vacation, like a full-blown rental, there's nothing wrong with that. If it's really got to be past 12 months. There's nothing wrong with someone buying an owner occupied, and after 12 months they convert it to a rental. That's not, illegal in any way. But if someone's buying it and immediately closes as a 10% down vacation home, and they hire a management company, it's a full-blown rental. Well, that's technically not, that's like mortgage fraud at that point, technically. So we don't want to do that, and we don't want to encourage that. The next loan is 15% down, which is also an investment conventional loan. It's a solid loan, and the rates are basically exactly the same as second home rates. But the advantage of the investment one is we can use projected rental income to qualify. So that helps someone's debt to income ratio. We can use 75% of what the appraiser long-term rents, not short-term rental projections, just long-term rent. So if it's $2,000 a month for the rent, then we can use $1,500. That would be 75% of that, and that goes as a credit of income towards our clients' debt to income ratio. So that's a helpful one. And then you get into bank statements or P&L loans or DSCR loans, which are very common with short-term rentals.
Yeah, and so we can quickly talk about DSCR, because I think that is like the biggest question I get. What is a DSCR loan?
Yeah.
They're not new, but they are all the rage now. So I think we went from doing like one occasionally to 5 to 10 a month or more. So a DSCR loan is a debt servicing loan where you use the house itself to qualify. So there are different banks out there. Some use short-term rental predictions, some use long-term rental predictions, but essentially an appraiser goes to the house and says, this house is going to make $2,000 a month. And as long as your mortgage, taxes, insurance, and if there's an HOA are all less than the 2,000, the house qualifies. That's a 1-to-1 ratio. The banks that use short-term rental data will still do an appraisal, but they also use AirDNA data. And if it says it makes $8K a month and the house, all of the costs and insurance, HOA, taxes are all under that, then it qualifies. That's 1-to-1. That's typically 20% down. They do say that there's a 15% down option. It's very rare that it closes. We've had one of those close. Almost all of them end up being forced to a 20% because the debt servicing doesn't work. And the ones that use short-term rental predictions typically require 20% down. So I would tell clients, bank on 20% down. We can certainly try for 15, but just know that it very well could go to 20. And then if the long-term rent doesn't cover the mortgage, and we didn't send you to a short-term rental bank for a particular reason, you can put 25% down. And at that point, it's a no ratio, right? They don't care if it debt services.
Yeah.
Yeah.
More money down solves a lot of problems in lending.
Okay.
But they don't take any
Good to
debt
know.
income. They don't look at your taxes. You
Yeah.
can own multiple homes, whereas conventional, you're capped at owning 10 homes. And some big banks like Wells Fargo won't even do conventional sometimes. I don't know what it is right now, but I think it was at 8 or 10, but now they just said they're reining it down to 6. So you start to get capped on conventional loans. But DSCR, you could do 1,000 DSCR loans, and most of them don't have restrictions.
Okay. That's fantastic information. So I think we've been talking most of the time so far about purchasing. Do you also do refinances of a short-term rental loan?
Yeah, exactly. Yeah. The cash out is very popular. I mean, with rates going up, cash out's got a little bit affected. But generally speaking, yeah, you go to 75 to 80% of the value of the home. I like clients to stay around 75%. The loan to value adjustment gets really expensive on cash out. So unless they really know they got to get to 80, they really need the money badly, then I try to do 75. DSCR, same thing. It's generally 75%. So yes, we do a lot of them. They're very, very common, very popular. And it's a great way for someone to scale and purchase something else.
And if you do a DSCR cash out refinance, there are stipulations there, like they either want to see that it was rented or they want to see that you improved it if you had not owned it very long. So just know that they're going to ask for receipts of improvement to show. They don't want you to essentially just pull out on market equity gain, and they don't want to hedge that bet. So they want to see that you massively improve the house and are essentially taking that money back versus just pulling out money from the market that may drop a little bit. So you do have to show receipts and things like that if it was recently purchased and renovated. If it's been a while, that's a different story. They'll just go off rental history. But if it's a DSCR, they do want to see improvements.
Okay. And then do you do just like home equity loans? So they already have their full mortgage and then they just want to do home equity loans. You do those as well?
We can do seconds, yes. We can only do seconds right now in our licensed states, which is California, Arizona, Florida, and Tennessee should be done any day now. But the DSCR loan, we can do that in virtually any state. It's a business purpose loan, so it's a different type of requirement. But yes, if someone, we'll take a call with anyone, at least give them advice. If we can't do it, we'll try to point them in a direction.
Sure. But they do take the banks that we're using are very slow right now for those. So at least 45 days. And it's a little bit of a painful process because it is so lengthy. But as long as they're prepped to know that these seconds, because they just got inundated, everybody's doing them now, their rates are higher. They are going to take a long time. So
yeah. It's kind of curious because that could be an option, because if they want to keep their first at that low rate and they don't want to refinance, then they could consider that. Okay. So what is one item that is often misunderstood when people are looking to finance the purchase of a short-term rental?
There's a few things. One thing I think is rental predictions. I think that's one of the things we.
Do you mean from like a mortgage point of view, or do you mean like from just in general?
From a mortgage point of view.
I would say income predictions. People will say like, well, this house is going to make 10 grand a month.
Certainly on DSCR. People are like, they don't. So the DSCR loan came out it was originally like a commercial style long-term rental loan several years ago. Short-term rental was not like factored. And then there was a lender that jumped in the scene that saw a need for it. And there is absolutely a need for it. And they would go off with the projected the data analytics. And there's a few more dabbling into that, which is good. And hopefully we get more and more. But at this moment, it's kind of like, if it's a long-term rent can perform, then those are pretty easy loans. If it needs short-term rental, then we're restricted to, it's like a supply and demand problem. So now you have just a few banks offering that. And so the expectations, as Tiffany was saying, cannot be met at times, and that's frustrating for us all.
Yeah, people get very annoyed because they'll say like, this house is going to make 10 grand a month. And I say, I agree with you. It is going to make 10 grand a month, but these banks are caught in the long-term rental scheme. And in their mind, this house is going to make 1,500 a month. And so I would say that would be one of the biggest things people misconstrue with DSCR is that like the house debt services. And I'm like, I totally agree with you, but the banks are largely antiquated. They don't use AirDNA. Even the ones that which we can broker to, the biggest one that only does AirDNA data, they don't even do long-term rental considerations. Even when we broker to them, sometimes it's lower than I would have anticipated what they're coming up with. So I think that is definitely one of the things that people miss. And then maybe claiming on tax returns. This is more for conventional.
Well, yeah. We've had challenges with people that they're not either claiming properly their income on taxes, and therefore there's a debt to income problem. So that's where partnering with us or another, like kind of like that financial analyzing broker from a mortgage point of view will help to say, okay, if you do it like this, you save money on taxes, but you don't qualify for a lot of loans. You got to do like no income loans at this point. And so, yeah, we ran into that. Like, and people just will tell us, oh yeah, I'm making.
They're like, I made $1 million last year. Or you made 30,000 on paper. And that's what the bank cares about.
Or just about their properties. Like, oh, they claim, oh, I'm making 10,000 a month. I can show you, well, on your taxes, you claimed you made, 20,000 for the year. And so where's that money?
Yeah. So that is, I think, another like misnomer, and people think they're going to qualify no problem. And then we look at the taxes and are like, well, we can do a DSCR, but you're not going to qualify conventionally. So
there's a bit of a mismatch.
There is.
Wonderful. So if you were investing for the long haul, and I know you all own several, is there anything that like any specific thing that people should do if they're investing for the long haul? Or another question would be, if you guys could go back to the very beginning of when you first started investing in short-term rentals, would you do anything differently?
Well, I'll go first. Yeah. I think that, right now, you should be patient. There's no need to rush. The market of being a buyer is coming a little bit more favorable to a balanced market. And I even during the crazy last 18 months, I didn't like buyers waiving all these contingencies and overpaying. It wasn't a balanced market. It wasn't fair, but it was what it is, what it was, or was what it is, kind of thing. But I think with pricing still high and rates higher, it's got to make sense. So be patient about it. Make sure you really like the home, make sure you can afford the payment, make sure your job is stable, and make sure if it's an short-term rental that do a lot of research prior that it looks like it can perform. And what Tiffany and I always do is, if we had to go long-term rent, like how does it do? And are you upside down a few hundred or a few grand? And because we've been upside down on a home before during the Great Recession. And housing,
a long-term rental.
Yeah, it was long-term, and we were upside down paying $400 to $500 a month. And I just rationalized it. It was like a Roth IRA. That's how I told myself I'm investing in. And so even though we were upside down in the value of the home and upside down in the rent, I treated it like that. And then eventually it bounced back. We made money, we sold, we made profit. So I think long-term people always win in real estate. But right now, I think you got to be, make sure you really like the home and in it for the long run. Not sure if you want to add anything.
Yeah, mine is more specific to just STRs in general. If I had to start all the way back over, the one thing I would not do again is buy homes in HOAs where avoidable.
Yeah, she's not a fan of that.
I am anti-HOA now. But in general, our very first one was a condo in an HOA. And as you can imagine, like HOA rates go up, so it eats into your return on investment. Just HOAs have a lot of power. They can shut the STRs down. And we've had several clients who had to sell homes because the HOA shut it down. And for that reason, I try to avoid HOAs if possible. We do own some in communities, like our Nashville homes are in HOAs, but those ones, every single home is an STR. It was written into the bylaws. They were built to be STRs. So I'm like, okay, I feel comfortable with that. The ones where people are living there as a primary, we've had very negative experiences with the HOA trying to shut it down or neighbor complaints. So that is the one big piece of advice I would probably say. Not to say every HOA don't buy there, but be very, very, very selective. If it's not largely rentals, I would think twice about it.
Sure. Okay. Good. That's very good advice. So if somebody was looking to, like, they knew they want to get this up to 8 or 10 rentals, what would be your advice or strategy for them?
Well, it comes down to qualifications. Are they cash buyers? They have a lot of cash, but they want to leverage that cash to buy multiple homes. And it's not that we're trying to get the business here. They need to consult a person of how they can scale. A financial advisor or a mortgage expert. And so that would be like, yeah, what do you want to get to? Okay, I want to get to 10 homes. Okay, cool. And you own just a primary right now. Okay, so you just mathematically, are we going to do 2 year? Are we going to do 3 year? How are we going to get there? And then do you qualify for all those? Generally speaking, if someone has, 20% down, they can almost for sure get a loan, like conventionally it's a good shot. And these other options from what's called portfolio lending, they're fairly want to lend money. They're fairly aggressive about it when you have 20%. When you go lower, like 15 or 10%, it's not as aggressive. It takes a little bit more planning, and that's okay. You don't have to have tons of money to be an investor. But that was our goal, was to have 10 homes and ultimately 10 paid off homes. I think that's freedom, because then you're cash flowing positive so much higher. But that was our original goal, was to get to 10, and we did it by, just slow scaling.
Yeah, we scaled over, I don't know, 5-7 years.
Yeah.
And one thing I tell people is, the first 3 are the hardest, because saving that down payment is hard. You probably liquidated a lot of your savings and you're making money per month, but it's not, like maybe you're cash flowing $1,000 or $2,000 per month. And that's hard to save like another 60K doing $2,000 a month. So, I always recommend, on the first 3, save everything that you can, put it into an account, don't touch it, don't take owner draws, leave it all there, use that account for your next house and then the next one. And once you get past 3 or 4, well, now you're cash flowing, 10, 20, 30 grand a month. It's much easier because those down payments collect quickly. So it's really hard on the first few, but once you get to 3 or 4, those down payments get easier to make and you can scale that way.
That's fantastic. Wonderful. So what's the best way for people to find your company?
Sure. You can look on Facebook for Full Circle Home Loans, Google Full Circle Home Loans, or Yelp, where our main office is in Upland, California, and it's Full Circle Home Loans is the name of the company. Do you have anything to add to that?
Yeah, just following us. We have a couple of groups about investing. So Tiffany can share that, and maybe we can send that to you. And following our company, the Full Circle Home Loans, is just one way of doing it. And then she has those groups, I think, that are good for people just to learn about what's going on in every market. And they're just kind of good discussions for first time investors, especially just how do I get started? So,
and then, they can, once they Google or Yelp or anything, they'll have a direct line to our office, and we reach Seth for consultations on financing.
Yep.
Okay. And again, which states do you currently do business in?
So we're fully licensed in California, Arizona, Florida, and Tennessee should be done any day. We filled out everything. And then North Carolina is it's in that process as well. Those are our every loan, conventional FHA,
first time buyer,
VA,
conventional,
yeah. And then, but the investor loans, those should be 50 states.
Okay, wonderful. So what would be 2 items of advice that you would give to all vacation rental owners?
Well, I think the one we kind of already hit, which is make sure that it makes financial sense to you if the market turns. So if you find out, because this does happen occasionally, we find people who should not be vacation homeowners for one reason or the other. They don't like it. They don't like people being in their house. Just for one reason or another, it's not a fit for them.
Yeah, if they have like cameras everywhere and they're like kind of spying on them, and you know, that's.
We've had clients tell us like, this is not for me. I feel like I'm watching cameras all day. I hate it. I don't like the idea of someone in my house that I vacation at. So, you know, we always say like, what is your contingency plan? So I think that would be my biggest tip is like, what is your backup plan? Are you okay just using it as just your true vacation rental or home, not renting it out? Are you okay long-term renting it? Or are you going to sell it? So have a backup plan even in down markets, since we are, you know, in a little bit of a down. Anything else?
I mean, my advice, I've circled back to what I told myself in 2017, which was, you know, my wife and I, Tiffany here, talked about if we could buy this condo in the beach and it covered its own mortgage and we could use it when it was available, you know, a few times a year, a few weeks to a few months a year. And again, like when we weren't using it, just we broke even, didn't cost us anything. We weren't making money, but if that could happen, would I do it? Well, yes. Like if everyone has that expectation of, I don't have to spend money other than my down payment, but then the guests are covering my mortgage payment every month. And maybe I'm not making really any money, but I'm not spending money at this point. They're paying my principal balance down. The values over time are going to appreciate, you know, 10 to 100%, whatever. And then I can use this vacation home for the next few, whatever, X amount of time a year. I think that's the expectation people should have. And I think it's for them. But if when we have clients like, oh, I need to make 10, you know, $2-3 grand profit a month, that's harder. So,
and everybody's goals are different. And so if that's what, you know, you're after, then yes, you're going to find a very specific house. But, I do think like my other tip would probably be, you know, don't focus just on cash returns. Like, are you gaining equity? You know, is the house being paid for? Are you going to have something that's going to be paid off quickly because it's being paid for? I would say, you know, all of those things go into account. Don't get focused just on like cash on cash or cap rate or things like that. Again, there's different ways to invest, and some people invest that way, and I'm sure it's fine, but, we have never focused on that. And we've done wonderfully in being able to sell houses for, you know, sometimes hundreds of thousands of dollars profit, that the house wasn't performing well, but it wasn't performing poorly, but maybe it only cash flowed $1,000 a month, but we sold it for, you know, 200,000 profit. You know, that's totally different. And people don't, I think, take that into account enough, how often just having a piece of real estate is very valuable, even if it's not cash flowing as high.
Right. And Seth, you had mentioned that you had started in mortgage lending back in 2003. So you saw some things in the last down market that I'm sure you learned from.
Yeah, definitely. 2003, I was a young, out of college and not even sure what I was going to do with my life, got involved in mortgage. And we're doing these loans that I didn't understand, like how people could get a loan with no documentation needed. And, oh, you have a 700 credit score, you don't have to put money down. It blew my mind. I didn't get it. But that's what we were supposed to do, supposedly. And then eventually, you know, we ran into this problem, especially with specific type of ARMs, negative interest ARM type loans. And as the market turned, because you can't just lend off of price appreciation. That obviously does not go up forever. And I think we're kind of experiencing that a little bit now. That downturn, I just learned that people have to, I came up with like a 3-question to ask yourself about buying a home. And that could be really any home. And it's like, number 1, do you like the home? Number 2, can you afford the payment? Are you comfortable with the payment? And number 3, is your job or your industry stable? Because in the recession, there was a lot of layoffs, so the jobs and industry stability was important. And then the second part about the payment, if you're buying a home that was uncomfortable, because I had a lot of clients in that 2005 through 7, they're like, wow, this payment's way higher than I can afford. I'm like, why are you buying this? You know? And so being real and confident with, hey, I can afford, $2,500 a month. And if I go $1 over that, I'm uncomfortable. Like, you don't want to feel that way. So be disciplined with, oh, I like this home. And if you don't like the home, why are you even buying the home? There's a couple of those questions I developed and learned over time. And when I consult with first-time buyers, we walk through that discussion, and if they answer yes to all three, we say, well, why not buy the home at that point, right? If they answer no to more than one of those, then I'm like, you shouldn't buy this home, and that's okay. Just be patient. We'll find another one. So yeah, I learned to just don't overextend, have some reserves.
And then just to echo something of that, I think we've already seen a lot of, the DSCR, the non-QM lenders, they started tightening up already. So that didn't happen in the last recession, right? It was just like, loans to everybody. But these now, they don't want that to happen again. So they were like, oh, like 15% down is not even an option now. Like,
yeah, if you cut off the 15% down DSCR, and some are going to be aggressive, and if the market isn't remotely correct, then hey, their gamble was good. But I think that the good thing about the crash was most lenders, investors, banks, it's so fresh still, even though it's over a decade.
They don't want it to happen again.
Yeah, so they don't want to be out of business because they did a bunch of aggressive loans. So I think people expecting a crash, we're not gonna get that. But also, I just think people should be conservative with, if you get approved for $1 million house, but you're uncomfortable, you don't have to do that. Don't do that. Like, buy something you're more comfortable with.
Yeah. Good advice. So is there one question that you wish I would have asked you today that you want to make sure and tell people?
I mean, it's a great question that I don't know if I've ever had someone. Oh man.
I can't think of anything specific, but
yeah, I mean, you asked, I think, a lot of pertinent, information questions. And I guess the only thing that I could just jump in, and maybe she'll think of something, is that, everyone's situation is different. Like, you should customize your own evaluation with like a team like ours, or anyone else you feel comfortable and trust.
Or like what you do with coaching and consulting, like you need, if you don't know what you're doing, you need to get professionals that do know what they're doing on their side.
Yeah. And I will say, like we learned a lot from trial and error, but we also cost ourselves a lot of money, because we didn't know what we were doing, even with these short-term rental investments. And sometimes we put too much money down. Like, why did we do that? Sometimes we're like, oh, we wish we did a little bit more money down. So there's a lot of things. I think having a team is actually very valuable. You're learning from wisdom, basically.
Yeah. And I think, just to like summarize for us, I want to say that Airbnb, short-term rentals, real estate in general has literally changed our lives. We were doing fine. Like, I was a PA, a physician assistant. Seth was doing mortgage. It's not like we were struggling, but it made our lives exponentially better. So we want that for other people, because I can't even express how much it's changed our lives, from just the extra income to the net worth that has just expanded exponentially from real estate. So I encourage anybody who thinks it's a good fit for them to get into it and, buy homes and go out there. And even if it's long-term rentals, now there's such a need for those. Those are starting. We've seen some make sense again more recently, which we had not in forever. So,
everyone's raising their rents now.
Yeah. So, but yeah, just, I guess to summarize, we really believe in real estate. We've invested in the market. We've invested in stocks, REITs, like everything, and nothing has made us more money in real estate. So that's my final message to everybody.
I think once somebody gets started on short-term rentals, as long as they do it correctly, they're hooked.
I agree.
Because I wouldn't be.
Yep. It's very rare. I mean, it's so rare that people are not hooked on it. So.
Right. All right. Well, thank you both so much for joining today.
Thanks.
I really appreciate it. And as questions come up, we'll make sure that we get back in touch again with you as well.
All right. Thanks
Thank
so
you,
much, Suzanne.
All right.
Bye.